So, Mr. Sahu, you had touched upon this whole concept of alpha and business cycles, how it affects both mutual funds and the stock market, etc. Can you just elaborate exactly how does it?
No, what I was trying to mention you that if we can catch the business cycle correctly, then there is a big possibility to create, alpha at our advisor level, because obviously we are putting money into the mutual fund, and the mutual fund manager is smart enough to see which stocks, which sector are doing well, and in their portfolio anyway they are doing allocation depending on the sectors which are going to outperform, and also the company which are going to outperform in general. That is number one. But since the whole portfolio is scattered through a lot of companies, unless the weightage is really very high, then in a portfolio level it doesn't give you any big extra return. So at an advisor level, apart from the asset allocation, if we understand, because in last 30 years of my experience, what I have seen, every market rally is formed by rally of a particular sector. If you see in Harshad Mehta time, the rally was about all the old economy stocks, your basic material like cement, steel and all those kind of things. Then subsequently the rally was more towards the FMCG and pharma, and towards the end of 2000 it was more on IT or what you call is famous dot-com bust. So then after for few years market consolidated, and again the infrastructure company, steel and cement, they were doing the big performer. And then after market went through another consolidation after the Lehman Brothers crash of 2008, and when the market again started giving the performance, it was again the same old FMCG companies, then pharma companies, then IT companies. So during this COVID also, these are the company which has given the best performance: IT, pharma and FMCG.
So what do you see, a repeat of?
So what I am sensing is that from time to time, this basic consumer and export oriented services like pharma, IT are basic export oriented services, and basic consumer companies like pharma and FMCG have done well. They have done their bit. Now the kind of money all these people of say pharma company or IT company or FMCG companies or their employees which will be making money, they are going to spend on actually real assets. And government spending so much money in infrastructure, see this double growth of reality and infrastructure should do well in the subsequent rally. And if we are positioned correctly in that space, that may again give some good return or extra return. So we are not directly exposing into this sector in a very large percentage, but of course, yes, this is the space where we feel that it will be giving extra return, and our cycle analysis helps us to spot these kind of opportunities. Even for that matter, we anticipate a lot of happening in the emerging sectors. So there are many portfolio which are positioned themselves into the future emerging sector where we should position ourselves to create that kind of return. Okay. So these are the different strategy we play around to generate the extra return.
So where do you see the focus right now? I mean, given the fact that the government is spending a huge amount on infrastructure, etc., do you find there will be more investment in value stocks going ahead?
Technically yes, because rest of the market is overvalued, right, like FMCG, IT and they are absolutely overvalued. So the focus should shift to this kind of thing. And you see, government is working on that front, creating the infrastructure, making Atmanirbhar Bharat, increasing the proportion of percentage in GDP of industrial activities. So I think these are the area where investment will also go and growth will grow. And what I have seen in the past, whenever this sector grows, there is a wide participation of stocks, not very limited to few stocks. So the whole breadth of the market participate. So I think generally market will do very well in the coming 5 to 10 years, and some of these sectors will also do extremely well compared to the last 10 years.